Hi, I'm Assistant Professor Aditi Mathur, International Schools of Business Management, Suresh Ganvia University, Jaipur. And today, in this video lecture, we'll be starting with a new concept that is capital structure. And today we'll be discussing few basic concepts associated with the capital structure. So let's have a look on all the topics which we are going to cover in this video lecture. So today, we'll be covering the meaning of capital structure, total capital required, then the factors influencing capital structure, optimal capital structure, essentials of a sound or optimal capital structure, the importance and the need to have a sound capital structure in an organization, and later on, the determinants of a capital structure. So students, we should first of all understand what do you mean by capital structure, right? So first of all, let us just split this term capital structure into two parts, capital and structure. So structure, structure a framework, right? It is like Hindi mein, if I say it is a dhacha, right? So capital structure means a structure or a combination of different mix of what? Of the debt and equity. So we all know that every business in this organization need capital, the money to start its business, right? So when you need a money to start a business, that money is capital and you can have it either through your equity or through your debt. So as per the definition of the capital structure refers to the combination or mix of debt and equity which a company uses to finance its long-term operation, right? So the long-term operations needs finance, and for that, the money which you take from either from the debt or from the equities, that ratio, that combo, maybe 20 is to 30, 50 is to 50, 60 is to 40, that ratio of equity and debt is known as your capital structure. Rising of capital from different sources and their use in different assets by a company is made on the basis of certain principles that provide a system of capital so that maximum rate of return can be earned at a minimum cost, right? So what we have to take into the consideration, the first thing, that whenever we raise money or whatever capital structure we are having, that should have or that should suffice two important points. The first one is your maximum rate of return. Now let me teach you this point with taking a small example. Let's take an example that I have given you 500 rupees and I have asked you not to expend it but to save it or to invest it. So definitely you will try to invest in that avenue which give you more and more of return. The same principle applies when a finance manager likes to invest his money, his capital, a big amount of money which he is investing in his business so that he can earn the return. So he will always like to have that capital structure which will help him out to earn what? Earn maximum rate of returns, right? And the another point to be taken into the consideration is to always have that capital which gives minimum cost. We all know that the cost is always associated with everything, right? So whenever we raise our capital also, it is also related with the cost. So the cost of capital, the total cost of capital should be minimum. So we should go for that ratio, that combination, that mixture of debt and equity, which gives you the maximum rate of return and minimum cost. So this sort of system of capital, right, that mixture of capital is known as your capital structure. Which capital structure? The capital structure which gives you the minimum cost and maximum rate of return. So the capital structure is refers to the proportion between the various long-term sources of finance in the total capital of firm. A finance manager chooses that source of finance which includes minimum risk as well as minimum cost of capital, right? So the risk factor also comes into the picture. Risk of what? Risk of your controlling, right? Risk of returning back that amount, risk of power of decision making, right? So if you have a capital structure in which there is lots and lots of debt component, then definitely the outsiders will have influence on your working. They will like to give their opinions, and they will like that they will be deciding how the organization should work, or how to invest the money, or from which source of income you need to buy what type of asset, right? So definitely whenever we decide the capital structure, the 3 points to be taken into consideration: maximum return, minimum risk, and minimum cost of capital. So when we talk about the total capital, so capital is actually summation of the amount raised from shares and amount raised from your debentures, right? So when we talk about the shares, we know that there are two types of shares: equity shares and preference shares. So the total share capital is what is the summation of the capital from equity shares and capital of preference shares, right? So when we say debt is to equity, it means total share capital is to debt, right? So it can be ventures, it can be long-term other loans. So now what are the sources of long-term finance? Right, there are many sources. The basically two which has been used to bifurcate is your proprietors fund and the borrowed fund. So the proprietors fund, which is also known as the owner's capital, is the summation of your equity capital, your preference capital, and your reserves and surplus. So when you add the balance sheet part in which your equity share capital, your preference share capital, and your reserves and surplus is given, that becomes your owner's fund or the proprietor's fund. And borrowed funds, the long-term debts. It can be debentures, it can be the loan taken by the other financial institutions or the banks, right? Which are for such a big period of time. Generally, it is for 10 years, 15 years, 20 years, and so on. So that amount. So what we are studying, we are actually trying to come up to a ratio in which our owner's fund is to your borrower's fund, right? And we have to maintain a balance between these two types of sources of long-term capital. So what are the factors which influence your capital structure? So there is a good list of factors influencing. So we have actually bifurcated these factors into two parts. One is your internal factors and another is your external factors. So let's just look one by one what all factors come under your internal factors list and the other in your external factors. So if we talk about your internal factors, so they include size of business. What is the size of business? That is your internal matter, and you can resolve it by yourself, and you can control this factor, right? So this is your internal factor, and it is one of the very important factor which influences your capital structure. Let's take an example that I have a very small size business, right? Maybe of, let's say, employees of total 50 employees working in my organization, right? It is not that good amount in comparison to your MNCs, maybe your Airtel or something like that. So what I'm trying to say is that when I have a small scale business, right? So definitely I'll require small amount or small capital. And in that also, I will have more of my, that means proprietor fund in comparison to the debt, right? So, and then that also I will like to have a money maybe from my relatives and friends, not from the bank loan, because I'm a very small person right now, right? So the size of business also matters, right? And that is why it becomes an internal factor, because you can definitely adjust your size. If I am good and I am in the top market right now as small size business, definitely I will increase my size. I will like to be a medium size, and then I will like to be a large enterprise, right? And for that I will open the boundaries of my district or of my working. Before I might be working in only a single district or in a state, but now I will like to work in more than two states. Maybe metropolitan cities are being targeted later on, and then I will like to come up to the pan India level, and then I will like to go to the international borders as well. So what I'm trying to say is, the way the size of your business differ, the amount of capital also differs, and which is to be taken into the consideration. The another internal factor is the nature of business. What type of a business you are doing? If you are doing a service industry, your capital will vary. If you are in a manufacturer business, then definitely you will require lots of capital, because you will have the laborers working, you will have the transportators for your working, you will have big factories, warehouses, lots and lots of people will be enrolled in your working organization. So that means the nature of a business plays a very vital role. And if I am a trader, I might not require lots and lots of capital, because my business is very short term in nature, in terms of I will just have the goods on the credit basis. I will sell it, and when I will receive the money from my debtors, I'll pay to my creditors. I don't need lots and lots of money. I can just work from one of the big warehouses which I have in my district, with the few employment maybe of 10 people, and I'm all sorted. So I don't need lot of capital with me if I am in a trading business only, right? But whereas if I am in service, then I might need a big amount of capital, because nowadays service industry is in a good competition, right? So that is why we say that the nature of business plays again a vital role in affecting your capital structure. Then the other points are your regularity and certainty of income. That means if you are from a business which makes you earn lots and lots of amount, that to an equal flow, that every month, or you have a very steady income, then definitely you will not have lots and lots of borrowing, right? Because you will have your retained earnings, you will be able to manage your cash. But if you are in a business which don't let you earn the money evenly, it gives you like you have earned in January, then you are earning in July, then you are earning in August, and then you are earning in maybe December. So in that way, in different period of time you are earning, and that too the amount is not somewhere down the line same. Maybe sometime you earn good amount of money, maybe you're not earning that much of money when you are not in season, seasonal goods. For those type of organization, you will require some loan amount, right? Because your savings will not be that much, right? So your regularity and the certainty of income is another important internal factor. Then comes your asset structure, that how many current assets do you have versus how many fixed assets do you have. Because if you need a money and you want to sell your asset, then definitely you will need lots and lots of time to sell your fixed asset, right? In comparison to your current assets can easily be converted into cash, right? But for the conversion of the fixed asset into cash, it takes good amount of time. It is not that easy to sell your building, it is not that easy to sell a factory, it is not that easy to sell a patent. It will take time, right? So that is also an important factor. Then the age of a firm, how old your organization is or how new your organization is, right? If you are a very new organization, you will need lot of money, because you will be setting up, you'll be setting up your organization, you'll be setting up new factory, you will be having some HR cost associated, because you will like to have the best employees. So then taking the interviews, they also incur the lots and lots of costs. So what I'm trying to say is, with the age of the organization, if your firm is very new, minimum, right? If you are expanding and you are trying to even go ahead the national level or maybe international level, definitely you will need lots and lots of cash. But if your organization is a bit old, right, you are there in the market, you have your own name, you have your goodwill in the market, then means that you will not like to have money maybe through the bank loan. You will go and out and might be go for an IPO, might be go and ask the money which is not yet called up by your equity shareholders. You might be there in the market of stock exchange already, right? So that is also one of the factors. The age also plays a vital role in your internal factors. Then come desire to retain control. Control in the sense of decision making, control in the sense of deciding what your organization will do, who will be our buyers, who are going to be our sellers, right? So for that control part to take the major decisions of your organization, that is also important. Who will take this important decisions? And definitely, if you are a proprietor, you are taking a lots and lots of pain. It is your idea, and it is your dream to have an organization, and you have worked day and night. You will like to take the power in your hand. You don't want that the people who have lended you the money, the bankers who have given you the funds to start your venture, take the decision for you or tell you that what is correct and what is not, right? So that is also a very important, because if you will have lots and lots of debt, the debtors will influence you, right? The people who have given you loans, they will influence you. Then coming to the trading on equity and the period and purpose of financing. These two are also a very important factors which on your capital structure. And that these series which we have studied right now, the size of business, the nature of business, the regularity and certainty of income, the asset structure, the age of the firm, the desire to retain control, your future plans, your operating ratio, the trade on equities, the period and purpose of the financing, they all are under your control. You can control them. That is why they are known as the internal factors, right? It is on you to decide that what should be the size of the firm. It is on you to decide that whether you want to go and have a new venture. What is your future plan? Right? So these are the internal factors which affect the capital structure. Then comes the external factors. As the name suggests, they are those factors which cannot be controlled by an investor or by a businessman, right? They are those factors which are common for all businesses, and they are external. They are not under your control, and they have a good impact on your capital structure. The nature of investors. What are the nature of investors? The investor is just putting the money in your organization so that they can earn good amount of return, or they are investing in your organization because they somewhere down want to know want to have a control on your business. There are n number of statutory requirements given by the companies. The another point of the external factor is the cost of financing. The cost of financing is actually what is actually in relationship with the amount which you or your capital have, right? So your capital generally is of equity, preference, and maybe of the debt. In debt also we can say that it can be from the bank loans or from the debentures. So the cost associated with the equity shareholders and the preference shareholders is the dividend, right? They want the returns which they are expecting. Then the initial amount which they are investing, that also. Then for the bank loan, the interest, the debenture holders, the interest. These are the costs associated. The flotation cost also, the transaction cost also are a part of the cost of financing. Then the seasonal variation, right? So the seasonal variation means that the business which you are having right now, in which season it comes, right? And even the seasonal variation is dependent on the seasons on the market in which the people buy your product. Like the majority of the sales for a good amount of the sales for the automobile in India is approximately when it is a Diwali season. People like to have more, or when the offers are there. So that also, when it is that month, or Diwali season, the production will be at its maximum, because you know that the sales and the demand will be there in the market. Your product is accepted and it will be in demand. You are very optimistic, so you produce at the maximum production level your organization work on. Then the external factor is your economic fluctuation. That means your recessions and all. So that is also one of the thing which influence your capital structure. Then the nature of competition. If you are into a industry which have lots and lots of competition, you definitely need lots and lots of capital, right? Let's take an example that we are in a shampoo industry, the FMCG sector. So in that, I know that how many competitors I have in my, market. I have L'Oreal, I have Sun Silk, I have Chic shampoos, I have Clinic Plus, I have n number of the products, n number of the competitors. So definitely I will like to have my product which is, having lots and lots of advertisement, giving lots and lots of new variants, coming up with in time to time new types of the activities to engage the people, right? So for that also I need money, and for that also my capital structure will be affected. So the nature of competition matters in that sense also. And when we talk about the nature of competition, we should not forget that in competition you will definitely like to have the best technology, the best production unit, so that you can produce the goods at the cheap rate, and you can have the best quality, so that you can add your profit margin and sell the product into the market which is lower in amount in comparison to your competitors. And that is how you are going to have the cost leadership. So for that you need to have good amount of capital, so that you can take the advantage of the new technology which are coming up, the new advancement which are up to the market. And that is also one of the external factors of which influence your capital structure. So now, what is optimal, or a sound capital structure? So the optimum capital structure is the capital structure at which your market value per share is maximum and cost of capital is minimum, right? So what I'm trying to say, it is that ratio or that combination of debt is to equity in which your MPS, market value per share, is maximum and cost of capital is minimum, right? So it is very important for you to select that plan or that capital structure which give you both these points. What is that? That is your minimum cost of capital and your maximum market price. So the optimal or the best capital structure implies the most economical and safe ratio between various types of securities, right? So that is very important for us to understand, that we have to select the most economical and the safe ratio. There might be lots and lots of plan. The plan can be 50 is to 50, 10 is to 90, 90 is to 10, right? Your 60, 40, 40, 60, your 25 and 75. That all things have to be taken into consideration. Of which plan has to be selected so that you are safe, you are economically sound, you have maximum MPS and minimum cost associated with it. That the capital structure, right? That mixture of debt and equity, which maximizes the value of the firm or the company and minimizes the cost of capital, is the one which is known as your optimal capital structure. Then let us just see few of the characteristics of a sound or an optimal capital structure of an organization. So the first characteristic is that the cost of capital is minimum. So when you talk about a sound, or when you imagine a sound capital structure organization, the cost associated with that capital is at the minimum. The risk should be minimum. The returns should be maximum. That means you should earn lots and lots of return on it. The control of the proprietors, the owners should be maximum. You should have a good control on your business. Safety should be the priority. That means that no one in the market should come and say that you have not paid the loans, or you have not given me back my money and interest, so now this organization is mine. No, that has to be taken into the consideration, that you becomes the owner. That is your safety to be taken. Simplicity. It should not be complex, that 2%, 5% preference share, 2%, 10% preference share, then 10% equity share, then 20% debenture and all. Don't be so confusing. Don't have that lots and lots of elements in your capital structure. Have a very simple capital structure, right? So that it is easy for you to manage the cost associated with it. Then the flexibility. Your capital structure should be in such a form that it becomes flexible the way you want it, right? So if you want to reduce your debt, so you should have that scope to reduce the debt, and you should have that scope to increase your equity line as well, right? So that flexibility should be always there in your sound capital structure. Then attractive rules. If in future you want to convert your debentures into equity, so you should have that scope. You should issue the redeemable or the convertible debentures, right? Don't go for the non-convertible one, so that if in future also you want, you cannot do it. So always have that attractive rules, have that flexibility with you, so that your capital structure can be molded the way you want it in the future. Because see, the future is unpredictable. It cannot be, imagined, or cannot be calculated with 100% accuracy. So you should always have this, scope in your hand to mold it, changes as and when required. Then it should, compile with all the legal requirements, right? So if you are raising a new capital, you have to come up with some reserves. You should have certain amount of money in your capital structure, reserves and capital, reserves and surplus. So you should be a organization which can adjust all the legal requirements whenever and whatever needed. So these are the characteristics of a sound or an optimal capital structure. So let's just have a quick recap on what all points are there. Number one, minimum cost of capital. Number two, minimum risk. Number three, maximum return. Number four, maximum control. Then safety, simplicity, flexibility, attractive rules, and the legal requirements should be compiled. Right? So these all characteristics, if they are mentioned, or if they are, there in your capital structure, so be tension free, because you have a sound capital structure in your organization. Right? So now let us just see the importance to have a good capital structure, or to know what is capital structure. So the first is that capital structure helps you to determine the risk assumed by the firm. So when you are calculating the risk, you will come to know that I have the debentures with me. This is also a risk, right? They might come up and they want to redeem at par. They might come and present and tell me that I want my money back, right? So I have to take that into care, right? If I have lots and lots of, outsiders' money invested in my organization, maybe in terms of the loans or the advances, then I have to take that risk also into the consideration. So whenever you take any decision, the capital structure helps you to calculate your risk. Then it helps you to determine the cost of capital of a firm. Then what is the overall cost associated with the capital of your organization? So we learned in the cost of capital that how to calculate the cost of the organization. So it is that easy. We will do it with the help of WACC, and that will be studied in the cost of capital chapter. Then the capital structure, it affects the flexibility and liquidity of the firm. Right? So we have discussed this point that how the liquidity and flexibility affects the organization's capital structure. So it helps you to, understand that you can see your capital structure and assume that, okay, this is what is my capital structure. So if I want to mold it, how much probability is there to mold it? If I want to redeem it right now, can I do that or not? If I want to buy back, can I do it or not? So that all helps you to understand it, or to take into the consideration when you are understanding or writing down the capital structure. Then it comes that one of the important is that capital structure affects the control of the owners of the firm. We have discussed this point earlier, that how the control of an owner is affected with the help of the capital structure. So you raise your more and more of debt, the less control power you have, the investor or the businessman have, right? So that has to be balanced so that you have a good control in your own organization. Then the another important point is, which I should discuss with you at this level, is the determinants of a capital structure, right? What all helps you to determine the capital structure? So the point number one is the nature and size of the firm, then the stability of the earning, the stages of life cycle of the firm, that in which life cycle of the organization you are. Are you in the introductory part, or in the growth part, or in the maturity, or at the declining level? So the level of your organization, the stages of your life cycle determines the capital need. If you are in introductory, you will need lots and lots of money, right? If you are in growth, you will need money to expend the business, right? If you are at the decline, you will again need the money so that you can survive in the market, right? So that is also one of the important aspect which we should look. Then the cash flow ability of the firm, we have discussed it in the characteristics. The cost of capital associated, rate of corporate tax, retaining control, flexibility, trading on equity, legal requirements, asset structure, and nature of investors. So we have discussed these all points, and they are actually also known as the determinants of your capital structure. So the another topic, or the another thing which we will be doing in our upcoming video, is that the capital structure theories, right? So the theories associated with the capital structure, there are actually four basic theories: the NOI approach, the NI approach, the traditional, and the approach. So we'll be studying up in our next video lecture. So before we wind up, let us just have a quick recap on all the points which we have covered today. So today we have started just with our new topic, that is capital structure. In this, we have completed the meaning of capital structure, that what is the meaning of a capital structure. So let's just have a quick recap on that. Capital structure refers to the combination or a mix of debt and equity which a company uses to finance its long-term operation. Then a capital structure should be in such a fashion that it have maximum rate of return and earn the maximum rate of return, and is associated at the minimum cost. Then we should always look for that capital structure which have minimum cost and minimum risk associated with it. Then we also looked upon the total required capital, which is generally from the shares and debentures. So from the shares, we have equity share capital and preference share capital. Then this was the sources of long-term finance. There are two types of basic sources. The first is the proprietors funds or the owners funds, and which is equal to the summation of your equity share capital, preference share capital, and the reserves and surplus of your business. And borrowed fund is the long-term loans you take from the banks or the other financial institutions or from the debenture holders. Then we looked upon the factors influencing the capital structure. So we saw that there are basically two types of factors, the internal factors and the external factors, which influences the capital structure of an organization. In internal factors, we talked about size of business, nature of business, regularity and certainty of income, asset structure, age of the firm, desire to retain control, future plans, operating ratio, trade on equity, period and purpose of financing. In external factors, we looked upon the capital market conditions, nature of the investor, statutory requirement, taxation policies, policy of financial institutions, the cost of the financing, the seasonal variation, economic fluctuation, and then the nature of competition. We talked about the optimum capital structure or a sound capital structure. So the optimum capital structure or a sound capital structure is a capital structure at which your market price per share is maximum and the cost of capital is minimum. Then we also said that it is a mixture of debt and equity which maximizes the value of capital or a company and minimizes the cost of capital. Then we saw the basic characteristics which are associated with a sound or an optimal capital structure. So those characteristics or the essentials are the minimum cost of capital, minimum risk, maximum return, maximum control, the safety, simplicity of the capital structure, the flexibility of the capital structure, attractive rules, and the legal requirements. Then we talked about the importance of the capital structure. We also talked about the determinants of a capital structure. Those are the nature and size of the firm, stability of earning, stages of the life cycle of the firm, then the cash flow ability of the firm, the cost of capital, the rate of corporate tax associated with your organization, the retained control, then your flexibility, trade on equity, legal requirements which your company should go ahead with, then the asset structure and nature of the investors, right? And we also have given you a preview of what we are going to do in our upcoming video lecture, that is the capital structure theories. The four are somewhere down the line similar and have lots and lots of differences. So we'll be studying them in depth with lots and lots of help of the charts, diagrams, and this will be in our upcoming video lecture. So the reference books I will suggest is these two books. That is, one is the Financial Management by M.Y. Khan and P.K. Jain. Even you can go for the Principles of the Corporate Finance by the four writers. These are all two important books in which these topics are covered beautifully. The web pages also have a good insight, so you can just check the reliability and the credibility of the pages on the web which you are referring. Just check the authenticity and then just go ahead with those pages also. If I have to say the pages, then you should actually go for the online ebooks. If you can go, there are many online sites in which the ebooks are freely there. You can download them and you can refer to those books, right? So now let's just have a quick recap with the help of the MCQs which I have prepared for you. So today, whatever we have studied about the capital structure, the basic concept, I have prepared a 10 MCQs. Let's see how much score do you get. So just take a paper and a pen and sit and answer the numerical, the MCQs which I'm sharing with you, so that you can evaluate yourself that how much you are scoring out of 10. So let's get started with the revision with the help of the 10 MCQs. The first two MCQs are on your screen. The third MCQ, identify the correct formula for the total capital. And the fourth MCQ is also to identify the correct formula when you add the equity share capital and the preference share capital. The fifth and sixth, again in the fifth question, you have to identify the correct formula for the proprietors fund. And in the sixth MCQ, you have to identify the factor which includes the size of the firm, nature of the business, asset structure, age of the organization. So is it external? Is it internal? Is it both internal and external factors, or neither internal nor external factors? The seventh and eighth MCQ. Now let's just check the last two MCQs. So I do hope that you are able to solve all the 10 MCQs. I just do hope that you all were able to solve the last these 10 MCQs which I have shared with you right now. So just let's have a look on all the questions once again. This is the question number 1, the question 2, 3, 4, 5, 6, 7th and 8th, and 9th and 10th. So just all set. So now let's just check the correct answers of all these 10 MCQs. So here are the answers. The correct answer for the question number 1 is D. Question number 2 is A. For question 3, it's B. Question 4, it's A. Question 5 is C. Question 6 is D. Question 7, it's C. Question 8, it's B. Question 9, it's A. And for the question 10 also, the option A is the correct option. I do hope that you have got all the correct answers. And if not, then again, just replay my video and study well so that you can score 10 on 10. And this is one of the very important aspect that we should always recheck on what we have studied. And MCQs are the best way to, give that quick review on your study which you have done right now. So thank you everyone for joining this video lecture. I do hope that you are now clear with the concepts of the capital structure. Thank you. Happy learning.